I'm Magnus Lind from Treasury Peer. I'm going to talk to you about the most important trend or change in corporate treasury happening now in 2014, and that is disruption. It's a very used word, but what does it really mean? Why is it happening now? And how does that affect corporate treasury? Well, to be able to answer those questions, you need to back down to 2008. When we had the start of the financial crisis and the G20, the leaders of the G20, including the EU, met. And then they say, we need to have financial stability. And how? Well, their answer was push out financial risk from the banking system. And that was a huge, huge mistake. Because the regulators took this as an order, and then they took the old risk dogma. And the old risk dogma has two essential investment priorities. One is government bonds. They actually come from the conclusion that all government assets are very risk-free, or are risk-free, and they have high liquidity. The second thing you can invest in if you don't invest, if you're a bank, in government bonds is actually real estate or mortgage. And that comes from the conclusion that real estate is very low risk, which is not the case if you understand the business model of real estate. When it goes up and you can be rich. When it goes down, there's nothing you can do and you will lose money. So that only creates bubbles. But this is what they took, and this is what the regulators still are running on, to eradicate risk in the economy. And what has that led to? Well, the banks have been forced to push out lending to corporations and buy a lot of government assets. So what they are sitting on now are bad assets. And the worse the country is, like for instance Spain, if you see Spanish banks, they have increased incredibly their holding of Spanish government debt. And that is not a good thing if you want to have financial stability. So the banks are vulnerable and the governments are vulnerable, and we have a huge risk of haircuts in the government debt going forward. The only sector that is strong is the corporate sector, because we realized very early, already 2009, that if we are going to succeed, we will have to hoard cash on our balance sheet. We will have to have alternate funding sources than the banks, and that has made us very, very strong. So, while the regulators are still trying to enforce new regulation, and we are seeing now that the consequences of this anti-business regulation that we have is that the SME, small and medium-sized enterprises, and a lot of low-rating companies have a big problem funding themselves. And what are the consequences? Of course, the consequences are high unemployment. If you see what is happening, it's interesting if you see UK, US and the continental Europe. UK and US, they're the policymakers and the politicians have pragmatically mitigated the problem that this anti-business regulation has introduced. But in the EU, they haven't. So EU doesn't grow, EU has a lot of social problem and has a lot of unemployment. So, but frankly, I would say that the policymakers and the politicians are clueless and they cannot control the regulators any longer. Currently, in 2014, the large companies are okay. They can get as much funding and as much banking business as they want. The SMEs and the lower rated companies cannot. But the large companies are saying, we remember what happened in 2009 and 2010. We don't want to depend on the banks. So they are disintermediating, which is basically a consequence of the regulation. So what should our policymakers and politicians in Europe would have done? Well, they should have introduced a much better payment system. That's faster, that's cheaper. Well, they say they're going to implement this SEPA, Single European Payment Area. But it's too late, it's not one standard payment, it's tens of payment standards. And it defeats its purpose. What they also should have done is forcing the regulators to focus on creating a system that helps companies finance, trade and working capital. They haven't, and they're still not having it. I will give you one example of how regulation really crashes trade. And that is what has been implemented to regulation against tax evasion and against terrorism. It's called KYC, Know Your Customer, and AML, Anti-Money Laundering. They are the biggest ones. In fact, what they stipulate is that if you're going to open a bank account, if you're going to send a payment, if you're going to receive a payment, you have to prove to me, the bank, that you are not a criminal. And if you can't, we won't allow you. And that is creating even problems inside the EU, between England and Sweden. We have experienced that. But imagine what kind of problems that creates if you're going to do business with emerging markets and third world, who really needs to increase their trade. So, in this situation, how do the corporate sector react? What do we say? Well, we have said, okay, we're going to comply to regulation, but we see that as only a cost, nothing good for us, and we are complying to the least cost and making that a simple process as possible. On the other hand, we are seeing visionary companies starting to discuss what is actually corporate social responsibility. And we have a big problem where the regulators is running in the wrong direction, the policymakers and the politicians doing nothing, and they don't have any means to do anything. And we are the corporate sector, we will suffer if there is social unrest. So what is actually corporate social responsibility? Is that only being green and equal? No, it's so much more. It is actually solving the problem of employment and solving the problem of the social unrest. And there are very interesting discussion going on there. If you come to the office of the corporate treasurer, how is disruption changing the way a corporate treasurer works? Well, firstly, like I said previously, the corporate treasurer is disintermediating banks and getting other funding sources, getting other investments, and other processes in place. Treasury Peer is involved in a lot of initiatives in the new disruptive area. There are happening a lot of good things and going in the right direction, and the speed is enormous. The momentum is really hitting high. And there are projects going on in infrastructure, in apps. There are projects being done by established players and by new players. And it would be wrong to think that the new type of banking that we are going into from the old type of banking, that will only consist of financial technology companies or fintech companies, like for instance the FX peer-to-peer platform Cantox, or the Funding Circle, that is a peer-to-peer lending platform, or TransferWise, that is a cheap payment platform. No, there are lots of banks disintermediating themselves, and probably it's not a bad guess to say that the financial system will reinvent themselves exactly in the same way as the airline industry did when the internet arrived. And now you have established players like British Airways competing for the customers with new companies like Ryanair. What is the actually characteristic of this disruption is that, and with all internet disruption, is that the customer gets the power. Previously you had the airline had the power, now the customer had the power. And this is a huge change, and that will also happen in a new form of banking. You will have much more transparency, you can compare, you will have lower cost, you will have higher speeds, you will have higher quality, much better transparency. In short, the new financial system will disrupt. The financial system that will evolve from this disruption will be a financial system where the customer is the winner, where the customer is the key.